Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps Morning Meeting, a Christmas special, a technology-focused special for our last event of 2021. For anybody who's joining us for the first time, my name is Mark Tobin. I am the founder of Coffee Microcaps, and I'm just going to quickly run through a few of these intro slides, and then we're going to get straight into it to our first presenter. I'd like to thank our sponsor for this morning, Meriwether Capital. Luke Winchester, who some of you may know, just launched his microcap fund in the middle of November. If that's something that might be of interest, please reach out to Luke for the relevant PDS. Quick compliance and disclaimer. And just an overview of the companies we normally have presenting on for anybody joining us for the first time. Generally capped under 300 million in revenue and approaching cash flow break even, or indeed are already profitable. From outside the resources and biotech sectors, what I like to call industrial microcaps. That can be microcap technology names like we have now, but it also encompasses financial services names, FMCG names, hardcore industrial products or services business, basically a catch-all for anything outside the resources and biotech sectors. Structured this morning's webinar, we've got three companies presenting over the next hour and a half. Each gets a 30-minute slot. 20 minutes for the preso and plus minus 10 minutes for the Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. That's if you can't join us for the full hour and a half this morning. You can catch anything you missed tomorrow, and indeed you can catch previous week's editions. We've been running these weekly since March. Twitter, you can also grab us on, LinkedIn, and I also write a weekly paid subscription newsletter where I profile one interesting ASX microcap stock every week, and that's on the Substack newsletter platform. First up, we've got the returning presenter, actually, John Grant, Executive Chairman of Firstwave Cloud Technology. After that, we're going to have William Creedon, CEO of Alloggio Group, a recent IPO listing from last week. And then we have Daniel Lai CEO and MD of archTIS joining us. And with that, I am going to hand over to John, who I know is standing by patiently. John,
good morning, Mark. Thank you very much.
No problem. If you want to start sharing your screen, I'll let you know when I can see it coming up, and I'll just turn off this video, John, just so we've got a clear view of the slides. Perfect. There we go.
Perfect. Thank you very much, Mark. Thanks for having me back. Yes, you're having me back because we've got recent, very important news for the company, which I will run through this morning. So let me just move straight into this. Those of you who don't know me, I've been in the industry, the IT industry, for about longer than I care to remember, 40 odd years. I started at IBM, but I ended up being a founder and a shareholder in a company called Data3, which listed back in 1997. I took it to the listing as the CEO and then stayed with the company as CEO until 2015. It's a very substantial company now, capped at almost $1 billion and turns over about $2 billion in revenue. I was also better known or otherwise known in rugby league circles as the inaugural chairman of the Australian Rugby League Commission. So what is Firstwave about? Now, I presented very recently on this, so I'm going to summarise this in a couple of quick slides. Our mission or our purpose, or what we try to do, is we democratise enterprise-grade cybersecurity-as-a-service for SMBs globally. What does that mean? Democratise means to make available to people who don't have the resources or capability or financial capacity to otherwise participate. So what we do is we take enterprise-grade cybersecurity products from leading global vendors such as Cisco, Palo Alto Networks, Fortinet, Trend Micro. We bring them onto our platform, we multi-tenant them and virtualize them, and we make them available to the SMB marketplace at an SMB price. And we do that globally. The Cybersecurity platform is the platform. It's the world's first open security management platform. It's open in that it integrates multiple third-party security vendors and the functions associated with those. Security across firewall, web, email, endpoint, and advanced detection and response. Full management of all of those offerings, irrespective of which manufacturer they come from, on one platform that delivers it to the end user. This platform is installed with our service provider partners, predominantly telcos worldwide, who then deliver these services, the individual services you can see there, to their end users. I'm in production now and due for schedule for release at the end of Q3 is a world-class in your pocket mobile interface front end for the SMB user that will tell them exactly where they are in terms of the security across devices on their network, and will also give them advice and options they need to take at any point in time to allow them to remain secure. Our distribution model, just to remind people, we deal with service providers serving the global SMB marketplace. It's a one to many more. That is, Firstwave supplies to many telcos, ISPs, managed security service providers around the world. They, in turn, some of them provide to their partners, but ultimately we provide to the SMB end user globally. So it's a distribution model which is multi-tiered. So we announced Monday last week the acquisition of a business called Opmantec. It's a transformative transaction for Firstwave, and I'm going to spend the rest of the time that I've got in talking to this because it makes such a difference to Firstwave and the options and opportunities for shareholders and people within the business, and our customers. So it's a really big deal, and we think it's an excellent. Clearly, we've done it, so we think it's an excellent opportunity for Firstwave to be a multifaceted and multidimensional business. Opmantec provides enterprise-grade network management. So it has software which sits in the networks of its customers and monitors the performance of every aspect of the network. It also has audit software which sits across the network and audits every device on that network, irrespective of what that device is. And that's a hugely complex task. And they have a very unique way of being able to do that, which is not copied and not available to anyone else in the world. And what that does, of course, is identify every device, be it endpoint devices, be it applications, be it Internet of Things devices, it doesn't matter. It identifies those. And of course, if they can be secured, then we can do that. Their customers are parallel to the customers that Firstwave has, are telcos and managed services providers, both of whom supply to their end user mid-market customers. They also have a direct sales force, which deals with large enterprises across the world. So they have two channels to market through the managed service provider or telco channel, indirectly and then directly through their own sales force. They have a very broad footprint. Their products, the NMIS and the IT audit software, are used by 150,000 organisations over 178 countries. And that's because when they were initially released, they were freeware. And what you can see in that diagram on the right is the two apps in the middle, NMIS and audit. That's the freeware. And then around it are the applications that are used to commercialize that freeware in the middle. But what that freeware does, it collects data from 150,000 organizations worldwide, which is how it furnishes its information library on the devices that can be attached to networks. And it provides a unique opportunity for network providers to manage their networks more fulsomely. They commenced operations in 2011, headquartered in Australia, with offices in the US and Mexico, being critical for Firstwave with 26 full-time equivalent staff. And they're a committed management team. These guys have been doing what they've been doing for a while, but they've also, as I'll outline in a moment, they've been doing the commercializing technology successfully for some time. Financial metrics around the business: revenue of $4 million in the FY21 financial year and 100% gross margin. It's different to Firstwave's gross margin, which has a cost of goods sold for licenses we buy from our global vendor partners. Their June 21 annualized recurring revenue is $3.4 million, which was up 59% from the previous year and compares with our reported international annualized recurring revenue of $3 million in FY21 and an EBITDA loss of $800,000. Benefits flow from all aspects of this acquisition. And I know people always say that about acquisitions, but this is different. I've sat in the middle of a whole bunch of acquisitions and watched a bunch of others, and I've sort of observed what goes wrong and what we've done wrong in the past. And so we bring that sort of experience into this transaction, but we also have, in terms of the transaction itself, intuitively, there's not a lot of opportunity for it to get too complex. Number one, it expands the product portfolio with a set of new applications that sit side by side in the application landscape and can be taken to market separately through the sales force of the two organisations. We get new channels to market through the managed service providers and a direct sales to market activity. It opens the US market for us. So we vested our future in the US in a relationship with Cisco, which has not worked out. So the US has been a vacant and needed market for us. And all of a sudden we're into the market with this acquisition because 60% of Opmentech's revenue comes out of the US. It expands our global reach by comparing the location of the two organisations, people and resources. And I've got a slide that will demonstrate that. It adds recurring revenue, which again I'll deal with, and lowers risk. Our current strategy is one where we're enhancing our product before we release it to the market. We've done the first version of that released early November. We'll do the second in February. So we've got time, and time is risk. So this overcomes that because we start to spread the risk across a broader revenue landscape. It bolsters our leadership, and I'll show you about that, and generates synergies that will reduce cash burn, and its value accretive opportunity is significant. 70% of acquisitions don't return the value that they've been targeted to do because there are definitely conflicts that occur either at the ego level or at the product roadmap level or at the technology level or at the operational level or at the sales level. This acquisition is hand in glove. It's as hand in glove as I've ever seen it. Where we don't have strengths, Opmentech does. Where they have strengths, where we have weaknesses, they have strengths. Where we have strengths, they have weaknesses. So it does work very, very well. And when you look into the future, there's an opportunity for these offerings to combine. And in very simple terms, if their open audit software can identify the security level of endpoint devices, for example, that are on the network and identify exposures, then we can remediate those exposures with our cybersecurity suite. And that's as simple as it can get. We're looking at how we do that. It's a sort of a mid-term to long-term opportunity. At the moment, which is substantial. That shows you our global reach. In Opmentech, people are shown in green, Firstwave people in red, and the Firstwave platforms that we deploy Cybersecurity are shown in black. And you can see it's a real global reach. What you can also see is there's almost no conflicts in any of the regions. So what we do is we use existing channels to roll out our two products, and we expand our global reach, almost doubling it, and particularly taking into account the US. If we then look at where partners are, key partners, the green key partners of Firstwave, of Opmentech, are their managed service provider partners, and the black ones are our key go-to-market partners. And now that looks like a map of an organisation that actually has got real global reach, and that is transformative for Firstwave. Transformative for Firstwave also is the way the revenue is now measured and can be shown. So on the left is Firstwave. This is the gross profit. I've down to the gross profit level because Opmentech has a 100% gross margin, and we have a 55 to 56% gross margin. So in working at the gross profit level, that's exactly what we get to deal with. So if you look at it at the gross profit level, on the left is our current FY21 distribution of gross profit, with 85% of that coming from Australia and New Zealand. If you add in Opmentech's FY21 pro formas, you get that on the right, with Australia reducing to 54%, but much more importantly, the USA and Canada at 17% and Latin America at 16%. That is a transformed revenue distribution model. They bring blue chip partners and customers. So blue chip partners such as Nextlink, Brennan IT, Telmex and NTT, and blue chip customers such as Microsoft, NASA, Charter, and Singtel, etc. They deal with the mid and enterprise with their direct go-to-market, and we deal with the small to medium business. So in the medium sector, which particularly appeals to the managed service provider channel, that's where we both work constructively together. Synergies come with the combined business. Firstly, on the cost front, we've identified $2 million in current plans for each of the businesses for FY23 or 2022 at least. We've identified $2 million that will come out. We don't have to spend, and there's some that are overlapping costs that we will remove, but $2 million to the bottom lines when you put the two plans together. As well as that, we've got revenue synergies. Immediately, we've got the sort of cross-sell opportunity, taking each of the sets of products out through the existing sales force across that regional map that you saw before. And secondly, the upsell opportunity, which is sort of the mid-term sort of proposition about how you bring the products together and leverage a stronger position from a customer point of view. Combined leadership team gets significantly strengthened. We're out to market for a CEO at the moment. Danny Ma, who's the Executive Chairman of Opmentech, will join the business as Managing Director and Chief Executive Officer. He's a foundation investor of Opmentech, but he has a long history of commercialising technology right from when he left university and joined the Prime Minister's Department. But Danny brings that sort of sensibility to the opportunities for Firstwave going forward. He also is a 16% shareholder in the combined business. So he's doing an all in here. And that's very good from a shareholder point of view. You know, I've always assured shareholders that in spite of the lack of shareholding at the board level and at the CEO level, we always have done the best for our shareholders. But I guess the reality of that now is with Danny having 16% share, that's real, that's true. Craig Nelson also joins the business. He's the current Opmantec CEO, but he resides in San Francisco in the US, and he has a sales team working directly in the US and Mexico and Latin America. That brings a really transformative change to Firstwave. Firstwave, not in the US, with no real overseas leadership. All of a sudden now, Craig will take the role of Chief Revenue Officer and Head of Global Sales out of the US, just brings a totally different perspective to this business. So I'm very excited about these two joining our existing team of Ian Bartram as CFO, Simon Ryan as Chief Technology Officer, and Roger Cavasso as Chief Product Officer. At the board level, we get Danny joining the board, but we also get Ray Kiley, a non-exec director. As a non-exec director, Ray is a current advisor to the board of Opmantec. He was the CEO of Intellidox previously, and they sold, and in that, Ray was one of the beneficiaries. So he's been looking for the right opportunity, and he's joining the board, which is fantastic, given his corporate lawyer background and the fact that he was Divisional General Counsel at Telstra. So he's got a Telstra familiarity as well. If you look at it from a pro forma profit and loss point of view, FY21, this is what you can see, a 43% increase in recurring revenue, but a 94% increase in gross profit. And that's really the story here. It's 4.3, as you can see on this table, of gross profit coming from Firstwave and $4 million coming from Opmantec. This lifts the gross margin on average to 69% from 54%, and of course the EBITDA margin improves. In doing these numbers, we've taken some adjustments. So we've rolled some of their development expense into the way that we account from it from a balance sheet point of view. But this pro forma also does not include that $2 million of extra cost that will come out that I mentioned a moment ago. So it's a very strong business when you put the two together. In terms of cash, we've got an integration plan which we'll do between January and June in 2022. We've allocated $1.2 million to do that, and we think that's conservative. The cash situation entering January after the acquisition settles will be $16.8 million in the bank, and you can see how that's formed by those elements on the left there. Revenue synergies are targeted to start in the first half of FY23. Cash burn for the combined businesses we're targeting to halve from $1 million 31st of December this year to $500,000 by June, and continuing along that trend ongoing. And we believe we have sufficient funding with the $14 million we've raised to reach cash flow break even. If you look at the capital structure, and I guess more significantly, how do we reach the pricing on this? We reach the pricing on a number of factors. And if you look at that little table on the left, gross profit has to be a major consideration in that. $4.3 million from Firstwave and $4 million from Opmantec, but that $4 million is all international. Our $4.3 million is predominantly domestic. So when you look at it from an international point of view, this is a very, very different business. And that justifies the equity split that we've got, let alone to account for the fact that we get a new CEO and a new head of global sales based in the US, and 60% of our revenue the Opmantec revenue coming from the US. At the end of the transaction, Firstwave's current shareholders will hold 46% of the company and Opmantec's 42% of the company. It is not a reverse takeover. And there's been suggestions that that's the case. It's clearly not. If you look at the board composition, you look at the executive composition. But the big deal, of course, is Danny Maher, as I said, they're 15% of overall shares in the business. So I said 16 before, but it's 15%. But that's a big deal, for all the reasons I mentioned a moment ago. So it really positions the business differently. This acquisition transforms on all fronts, transforms Firstwave. We've got a combined proposition for clients that'll give us an opportunity to have twice the conversations with existing customers. We get increased scale as our revenue grows. The IP is ours, it's proprietary. Global opportunities through that global reach slide that I said a moment ago to accelerate growth. Profitability that comes with the Opmantec revenues and synergies that we've identified. And we've got a very different team now to manage and direct the business. That's about it, folks. Look, really happy to take any questions. Thanks, Mark.
Thanks, John. And I'll just mention John has got about 5 minutes left with us before he has to jump into his own AGM. But I might just get the ball rolling here, John. In terms of the combined entity, are you going to rebrand Upmantech to Firstwave as well? Because it seems like they've got a pretty strong name in the markets that they're in. Is the plan to put it all under Firstwave, or are you going to keep the two brands separate but just kind of sell under both banners?
No, all under Firstwave, and the products that Upmantech has will be called Cybersecurity, Network Management, and Cybersecurity Open Audit.
Okay, great. And then in terms of, you talk about the combined revenue post the integration with Upmantech, it's, whatever, I think it was 15-16% of your overall revenue. Where are they in terms of the US market, in terms of, share of the addressable market? Are they the market leader? Are they one of the challenger brands?
Yeah, they're a challenger brand, Mark. They've got two in the pitch that we did around the acquisition to shareholders. There's two very good case studies. One of them is Telmex, which is a big telco, the biggest telco in Mexico, one of the top 5 in the world. Telmex replaced their existing HP network management system with Upmantech's NMIS. And they did that because their system from HP could not scale. And in fact, HP paid Upmantech to replace their own system. They had a similar experience with Microsoft. Microsoft had SolarWinds, which is a network management system that operates on Microsoft infrastructure. So it's a preferred brand by Microsoft's internal IT group. They again replaced SolarWinds with Upmantech's network management system because it could not scale either. So they've had great success in terms of being a challenger to existing brands.
And then just a question around the integration in terms of timelines to get it fully integrated in terms of, back-end operations, getting everything onto a kind of a standard Firstwave tech platform. Are we looking at by the end of calendar year 22 that should be all done and dusted? Is that fair to say?
Yeah, we've got an integration plan which currently its objective is to be completed, except for what you've just observed, which is back-end systems, but for the rest of the business by June 2022. And if you look at the way the business is merged together, let me very quickly describe that. So firstly, we were looking for a CEO, they have one. They were looking for a CFO, we have one. They were looking for a CTO, we have one. We were looking for head of global sales based in America, they have one. So at the executive level, it just goes hand in glove. So it's really from a bringing together the business and bringing together the people in the business, it's a really simple and logical org structure that we'll walk forward with. So that's one of the biggest issues that sort of dilutes the ability to be able to get value out of acquisitions. So our people will fit together very, very well, both geographically and both from a role point of view. Our products, we'll keep our product sets separate for the moment. And then in the course of FY23, we'll look at what the real opportunities are to bring these products together that make sense to our customers. So if you think about it then, an Upmantech existing sales team based in the US, which currently sells the Upmantech products, all of a sudden it gets a brand new portfolio of products in security that it can sell to the same people it's dealing with from their own sales point of view. So they get double the products in their kit bag to sell to the same customers. That'll happen over the course of this next 6 months. So we think in the 6 months through till June, we'll have accomplished all of the front end stuff and a lot of the back end personnel stuff. Then we've got the systems thing, which we'll start dealing with in the first half, which will resolve by the second half of calendar FY22.
And just one final question before I let you go. By the time you get to the end of the integration plan, what you said by the end of June, does that mean then that you should have hopefully realized the 2 million in synergies that you're hoping to get out of this deal? Or is that, a bit longer with some of the back end systems, in the first half of 23?
No, the $2 million is cost that we will take out in the second half of 22. That adds, by the way, to $2.5 million that we talked to our shareholders about at our Q1 update that we were going to take out of the business as well. So there's a net $4.5 million coming out of the business. That's a large amount of money. And that'll be done by June 2022, which drives, the opportunity to reduce our cash or halve our cash burn by June.
Okay. John, I going to let you go because I do know you have to join your own AGM in 5 minutes. Thank you very much for joining us this morning and giving us the update. And we will keep an eye. I guess the next update post the AGM will be the Appendix 4C at the end of January.
That's right. Thank you very much, Mark. And I say in closing, investing is about time. Sometimes things happen just at the right time. So to the listeners to this webinar, if you're not shareholders in Firstwave, and I'm not advising you to buy, I'm just suggesting to you that a lot about investing is timing. This is at the start of a whole new opportunity for Firstwave. We think the timing's very, very good for new investors, and we would welcome new people onto the register. Thanks very much for having me, Mark.
No problem. Thanks, John. And I do know we have our second presenter ready and waiting in the wings. So we'll go to him as we speak. So Will, if you want to start, yeah, it's just coming up now. And if you can just make that full screen, please, Will. Yeah, perfect. Okay, you're good to go, Will.
Good morning, Mark. Good morning, everybody. Thank you very much for the opportunity to be here this morning. As Mark said, my name is Will Creedon. I'm the CEO and founder of Alloggio. Alloggio is Italian for accommodation, and that's what we do. We operate in the highly fragmented market of short-term accommodation across Australia. We founded the business in the 21st of December 2015. And from day one, we went about creating our technology platform so that we could operate in two key divisions. And that is the first division being holiday property management, where we offer end-to-end management solutions for holiday property owners in popular destinations across the east coast of Australia. And the second division is where we commercially lease and operate mid-market hotels in New South Wales and Queensland. Just a quick snapshot on the financials, a little bit more on this later. Revenue to the 30th of June 2021 was 11.3 million, which is a 51% increase on the previous year. Important to note, that excludes rental concessions and any COVID stimulus grants, such as JobKeeper. EBITDA to June 30, 2021 was 4.7 million, up 70% on the previous year. And very pleasingly, our EBITDA margin to June 21 was 41% compared to the EBITDA margin of the previous year of 37%. Just a quick overview of our industry. The industry itself is over 100 years old, estimated around 500,000 holiday homes across Australia. It's a large and growing market of circa $7.3 billion. The Alloggio's total addressable market is somewhere around 120,000 holiday homes. These are mid to upmarket homes across the country. Just to give you a bit of a flavor of the landscape, absolutely there is specialized small holiday property managers across the country. But traditionally, holiday homes, the collection of those was managed by traditional real estate agents. And as you can imagine, traditional real estate agents, their main focus is on selling residential property. Their secondary focus is on permanent rental of those properties for either 6 or 12 months. Their third focus is around either commercial leasing, and the forgotten child, so to speak, is the holiday home rental. Because the second thing is, traditionally, as I mentioned, those principals and those sales agents is about selling property. It isn't about hospitality and tourism. It isn't about curating and coordinating cleaners and linen, making sure that bottle of wine is sitting there ready for the traveler and the owner to arrive. And it's not about ensuring that the guest reservation and the transition of that reservation from once they book to their arrival and during their stay and after their stay is looked after. The other thing that has allowed us to enter into this market is that over the last number of years, there's been certainly an uptake in from local government and state government compliance around short-term letting, code of conducts, etc. Again, those new processes need scale and opportunity. And finally, another reason why we've entered the market is that the principles of your traditional real estate agent are aging, and they don't want to spend those funds on technology to ensure the proficiency of the duties and the ever-growing expectations of the guest and traveller to the holiday home, as well as the holiday home homeowner expectations has risen. So they didn't want to spend those hard-earned funds over their many years on those technologies for a small amount of properties. The other thing that's important to understand is in the Australian domestic market, domestic tourism, for many, many years, but taking a snapshot since 2015 has been growing on a compounded annual growth of 5.9%. There is no question that there's going to be a return of international visitors. There's no question that Australia and towns and cities across Australia will continue with aviation route development and so driving more travel. Australia itself, both locally and internationally, has got a strong reputation for great service and people want to see and experience Greater Australia. This all flows to a very, very strong returns for holiday home owners and by default Alloggio. I mentioned some technology advances over the last number of years. And in the holiday home or short-term rental accommodation, there is no question there has been, but it's been led by what we call online travel agents or distributors. Online travel agents are, for example, Booking.com, What If, Airbnb, and Stays. But it's important to understand what they are. They are booking engines. And in Australia, for example, of the two very important facts, of the 500,000 holiday homes, less than 50%, in fact, just shy of 224,000 are listed on those online travel agencies. Of the 500,000, less than a quarter, 25%, are on more than one. And this is an opportunity for Alloggio. What Alloggio does is enter into an exclusive management agreement with the holiday home owner. And with that agreement, Alloggio manages and curates the property. For example, the gardener, the plumbing attendant, the housekeeping, the linen, the hamper, the chef, the chauffeur. It takes that, curates it, takes that content, and then places it on our own websites and marketplaces, and also places it on those OTAs such as Stays and What If. It's important to note here that Alloggio creates over 50% of its reservations from its own websites and assets. And it handles all of the bookings from the OTAs to our holiday homes. They hand over the baton, so to speak, of the reservation, and we handle the communication with the guest, the key collection, and all of the activities that go into the home, the physical activities of housekeeping and linen and such things. So we work hand in glove with those OTAs. And across Australia, we're one of their biggest partners, if not their biggest partners today in the holiday home industry. I now just get into our business model. As I said, we operate in two key divisions. We provide holiday home property management, end-to-end solutions for property owners. To the 1st of September, we had 879 holiday properties on our platforms. In our second division, we commercially lease and operate mid-market hotels. We have 13 across New South Wales and Queensland, some under independent brands and some under the Alloggio tag. I mentioned earlier that we went about creating our unique technology platform from day one, way back on 2015. And we're continuously evolving that platform to drive efficiency and to drive more reasons for travelers to travel and use our different destinations on our homes and our hotels across the country. This has allowed us to drive efficiency. For example, take the last year, where EBITDA margin has gone from 37% to 41%. I'll just tease out a little bit the holiday home division. When we talk about property management, what we do in the end-to-end property management solution is we, as I said, coordinate all of the cleaning, coordinate all of the guest communication pre-arrival, during the stay, and post-arrival. We coordinate and manage all of the reservation funds, the monies, and the payment on behalf of the holiday home owner. And as well as that, we curate all of the different information and we distribute it, like I said, on our websites and on the OTAs. Presently in Australia, in holiday homes, we go from Noosa right down to the Mornington. So for example, Noosa Holiday Rentals in a very, very popular area right in the heart of Hastings Street in Noosa. Port Stephens accommodation, Coffs Harbour accommodation. In Newcastle, we got Newcastle Staves, the very, very popular and exclusive Jervis Bay Rentals, Mollymook Milton Holidays, and down in the Mornington, in Sorrento and Mornington itself, and as well as Rosebud, we've got Verb Vacation Rentals. And it's I wanted to take a moment here to talk about two things. Firstly, when you look at the map on the right-hand side of your screen, you see where we are. There's a lot of blue space where we're not. And we're focused over the next weeks and months and years of continuing to grow our destinations across Australia. And we've got an extremely healthy pipeline of varying stages of investigation that will populate some new destinations and also bolster some of our existing destinations. The second point I wanted to emphasize is that it's important that we offer a hub and spoke model. In the hub, centrally we manage reservations, revenue, dynamic pricing, finance, and digital marketing and such things, and our technologies. And in the spoke, we absolutely appreciate brand equity. We absolutely appreciate the localized relationships with our cleaners, our housekeeping, our linen providers, our gardeners, our electricians, our plumbers, etc. We absolutely appreciate that it has taken years for those relationships to nurture. So when we go into a location, for example, when we purchase a holiday rent roll from a traditional real estate agent, and I take Dan and Michelle up in Noosa, fantastic people, or Kurt and Catherine down in Mornington. We take not alone their brand, but we also take their team. They have the relationships with the cleaners, the housekeepers. They have the relationships with the owners. We absolutely make sure that they're still intact, so that we can call on them. We can call on that local knowledge. But it also means that when holiday home owners invest in that location, they can come to see us locally. We have our offices in those locations. For example, right in the middle of Hastings Street, we have our office. So new holiday homeowners can come and see us. Our existing holiday homeowners can come and talk to us because we know what's going on locally. We're part of the event scene. We're a part of the experience scene. And this is really crucial to ensure the continuity of building our platform, building our brand, building our local relationships, and using our central hub of driving efficiency. So it's really, really important that we continue in that vein and continue the fundamental characteristics of why that industry has been around for over 100 years. We do something similar in our hotel business. But what we do in our hotel business is we actually remove the barriers to a very efficient way of connecting with our hotels, entering and leaving our hotels. So in most of our hotels, we actually you use smart technologies that open car parking, lifts, foyers, and our hotel room doors, and you leave accordingly. So it's a very, very quick mid-market quality experience that is very efficient. And like I mentioned, these are some of our brands across New South Wales and Queensland. What's really exciting is, I must admit, over the last, since 2015, is watch and see how we have grown. How, firstly, having built our technology platform and using it, having nurtured our people and attracted some fantastic people. And you know, our last pay run, we had circa 83. Well, we had 83 staff, and so we have the team in place. And what does it really mean, the IPO to us? It gives us the opportunity now to leverage not alone the technology platform, not alone our strong team and our strong board of directors, but we've also managed and acquired over 24 acquisitions in that period alone. So it gives us the opportunity now to go exercise our 4 key pillars for the next weeks and months and years ahead. That is, number one, we're going to absolutely grow our holiday property management businesses. We're going to keep acquiring holiday home management rights across the country. Like I said, in new destinations and in existing destinations. We're absolutely going to continue to procure mid-market hotel leases. We're going to continue to build out our technology platform to drive efficiency, but more importantly, to drive value for our holiday home owners and by default, Alloggio itself. And we are going to give more reasons for travel, more reasons to book our different types of accommodation in our different locations. You know, it's about talking to our existing customers or repeat customers and absolutely exploring the new experiences that will drive new customers. And what I'm talking about here is that, for example, surfing and sailing and hiking, etc. Absolutely being the forefront of driving those localized experience and taking them and scaling them, not alone domestically, but also when international travel occurs. I mentioned we've got a very, very strong management team, but we've equally got a fantastic board of directors. And a shout out to John Murphy, our chair, very, very experienced board, very well known to a lot of you. He's the man that is guiding us. And our fellow directors, Matt Keane, Karen Howard, and Chris Snedden, all very accomplished people and steady. And we're very, very focused on our future. And that is to continue to acquire holiday management rights and ensure that we drive organic growth, both with our existing platforms, but our new ones. Now, this slide is very important to us. This slide talks about our key operating metrics. These key operating metrics, to the first is our gross booking values. The gross booking value is the amount of money that we collect in hotels and in holiday homes. So in hotels, we take 100% of the revenue, and you can see the dark blue has been climbing from 3.7 million in June 30, 2019 to 6.5 million June 30 in 2021. Our holiday homes business has gone from 7.9 million in 2019, 8.9 million in June 2020 to 18.2 million on June 30, 21. From there, we take the next key slide, and that is our division contribution. And this is equally important. This is what each of those 2 divisions contribute to the overall business. What's important, like I mentioned, in hotels, we take the 100% revenue. However, from that revenue, we pay our cleaners, our consumables, but also our commercial rent for the use of those properties. So that takes, for example, the 6.5 million in gross booking value in 21 down to 2.1 million after those expenses in June 21. In the holiday home, it's slightly different. What is different about it? The gross booking value in holiday home business is the amount of money that the traveler pays into our regulatory trust account. The trust account holds the money for the cleaners and all of the different vendors, as well as our management commission. But more importantly, it also holds the money for the holiday home owner, the rent, so to speak. And from the gross booking value of 18.2 million to June 30, we held 4.4 million of that for our business. The third portfolio is about growth. How do we grow? Well, in our hotels from June 19, we've gone from 197 rooms to today 428 rooms. In our holiday home business from 2019, we've gone from 510 to the 1st of September, 879 properties. We had a dip like every other holiday home business in the country last year due to COVID. People, holiday homeowners went from their properties in the metropolitan markets into their holiday homes to get away from COVID. Of course, we rebounded quickly, and you can see that the growth was substantial a year later. Now to some of our performance. Revenue has increased since financial year 19 to 21 by from 5.8 million to 11.3 million. That's a compounded annual growth rate of 40%. And I mentioned earlier, that's outside of any rental concessions or COVID-19. Our EBITDA has increased for the same period, 19 to financial year 21, by a whopping 204%. And our margin has gone, EBITDA margin has gone from, again, from the year financial year 19 to financial year 21 by 27% growth. So Alloggio is well positioned to actually deliver on its 4 key pillars. As I mentioned, acquisition of holiday property management rights, procurement of hotels, building out a platform, and driving reasons for travel and using our properties. Before I hand over to Mark, I just wanted to reestablish our key takeaways. You know, we've got some compelling fundamentals in a large and extremely fragmented market. Remember, 500,000 holiday homes, $7.3 billion of an addressable market. We're already one of the largest operators of short-term rental accommodation along the east coast of Australia. We have got a proven business model. We have our own already built technology platform. We have our key people in place. We have our board in place. We already have strong financials and operating metrics. Now we just need to add the scale. And by God, have we got a pipeline in front of us. Over the last, you can please remember, we've already done 24 acquisitions. So we already know, and we have built the tools to ensure that we can efficiently and extremely quickly embed those different management rights bolted into our platform. It's practically overnight, 24 to 48 hours. And we have built the technologies and the tools to do that efficiently and quickly. We already have an identified pipeline of future holiday management rights right in our sites at varying levels of investigation, some much closer than others. So so Alloggio, or ASX ticker ALO, is primed to take advantage of our IPO. We're ready, we're firing, and we're about to lift. Mark, over to you.
Thanks, Will. I just wanted to know, I mean, you guys are, I guess, breaking the mold a bit in Australia, but is there anybody internationally who's also doing the same thing in this space, maybe, you know, in Europe or the States, you know, where they're completely focused? If we, you know, let's keep the hotel business aside for a second, but completely focused on the holiday rental management, but, you know, with this kind of corporate structure over the top of it, so it's not, you know, a particular location or 1 or 2 locations.
Mark, great question. There is. For example, in Europe, there's sites out of the UK, circa 150,000 holiday homes. In the US market, there is Vacasa, circa 190,000 holiday homes. There also is, out of Origins and Foundation in India, but a huge footprint across Central Europe and into the US, is OYO, OYO. They are very similar to Alloggio. They have a hotel division and they have a holiday home division. They, again, over 200,000 holiday homes. So what is happening globally, and we here in Alloggio are the first mover advantage in Australia, is that you need to bring scale, to bring efficiency, to bring service and a level of service, and to meet the expectations of the traveler today and the holiday homeowner. Over the years ahead, there's certainly going to be more compliance around how we manage short-term letting. And there's certainly going to be more, as I said, there's expectations, but also there's going to be growth in distribution. And what I mean by that is that those companies and Alloggio have recognized, and I'll give you a practical example here, is that, for example, in Australia, the hotel world has been distributing its hotel rooms to the online travel agents, as I mentioned, to inbound operators, so the people that connect internationals to hotels in metropolitan Australia as well as regional Australia, to wholesale agents that act between those retail agents and the properties themselves. And also in hotels have been dealing with your traditional travel agent that's on the high street. But in the holiday home business, we have none of that. We do not connect to the wholesalers. We do not connect to the inbound agents. We do not connect to your traditional high street travel agent. And this is where companies like Alloggio, in particular Alloggio, are building and have built platforms to allow us to do that into the future. So this will open up another opportunity, a new market, so to speak. And our fellow businesses similar to us in Australia, like I mentioned, Vicasa, IO, Sykes, Waze, and others like that are taking advantages of it now, and we see that. So there's certainly a blueprint, Mark. Okay,
and then we've got questions coming in from the audience, but there's one question I just want to quickly get in here because I'm intrigued by the answer. At the start there, you were saying, 50% of holiday homes, give or take, are not on with, what I would say are, the big three: Airbnb, Booking.com, and I don't know, we can say Stays, Expedia, whatever the other one was. But for the ones that aren't on there, why is the reason that they aren't on there? Have they got enough, inbound direct inquiry or repeat business that they actually don't need to utilize those platforms? The experience is so good that, they just ring up the owner and say, hey, what availability have you got? And it's generally booked out, and they say, okay, well, we take the first available weekend. I'm just wondering why those other 250 odd thousand actually aren't on any platform.
Okay, so great call out. Practical answer. What you've just given is about 10% of the reason why. But the main reasons are this. Believe it or not, most of the holiday homes in Australia are self-managed by the owner themselves. Because they don't have the technology, they can only put themselves on one platform. They don't have the property management systems or the technology platforms to do multiple distribution for calendar synchronization, reservation and portal management for multiple OTAs as well as their own website. They don't have the technology around dynamic pricing to actually allow themselves to move quickly and simultaneously with the supply and demand of a particular geography. So even though the industry itself is over 100 years old, it is still quite youthful in its adaptation of technology and its adaptation of understanding the distribution to market. And so we at Alloggio recognize that, and we've built our technology platform to allow us to quickly meet and list those holiday managements from those self-managed holiday homeowners, deal with the code of conduct and the compliance of the regulation, but also manage all of the housekeeping and linen, etc., and distribute it to the market. So we're growing, and because of that 250,000 not being distributed to many OTAs or multiple marketplaces. The second thing is important as well, is right across the country, holiday homeowners just simply have been giving it to traditional real estate agents. And again, like I said, those real estate agents have built their own brand over the years and are happy with what level of bookings that they've been getting traditionally over the high season. If you think of the high season in Australia, it's about, depending on where you are across the country, it ranges from 12 to 18 weeks. Now, what they're not doing is opening it up to shoulder seasons, both from their own distribution channels, because they don't have the technologies to do it, or the OTAs. And of the 24 acquisitions that we've done in the past, there's been a number of those acquisitions that actually haven't been distributed to the big three, as you call it, or the other online travel agents. So it's an opportunity for us to take as many of those holiday homes across the country as possible and distribute them to as many markets as possible.
Okay, we've got questions here from the audience, Will, so I'll just tackle them as we go here. Size of acquisitions you're looking at, what revenue sizes are these?
Yeah, so it's we have a very, very strict criteria, and I'm going to stay on the holiday home management rights side of the business. So our criteria is that we want to be within 150, 180 minutes of a major urban centres or key airports. This will drive value of home and drive bookings, or the amount of bookings. It'll also ensure that we can have the spoke model that I talk about, very, very strong brand in those local destinations of high amenity, so that our team can go in and out of each of the holiday homes prior to arrival of our travellers and our owners, so that things are right and looked after and welcoming for the guest. The second thing, so what does that mean? It means that we look at property management rights of circa 80 to 90 properties plus, so that one, they bring a level of scale about them. And if we're to enter new destinations, that's what we do in particular. If we're already in a destination, we can very easily bolt onto our platform, property sizes or amount of properties of 20, 30, 50, 70. Across Australia today, and as I mentioned, we're one of the largest, if not the largest holiday property manager in the country, circa 880 odd properties. Our next is just about 100 underneath us, and then it drops to around 600 odd properties. There's a fair collection of property management companies that sit between that sort of 90 to 280 holiday homes in a portfolio, so to speak. So there's a great opportunity for us to really quickly acquire them. And when we acquired them over revenues over the last 3 and 4 years, and we averaged that. And we apply a very rigorous framework of revenue multipliers and EBITDA multipliers to ensure that we've got continuity of revenue, and also that we have the ability to drive more bookings through those properties over the months and years after we procure that acquisition.
Next one, can you talk about source markets of bookings, i.e., what percentage of bookings are from within the same state? So, somebody from Sydney booking in Coffs Harbour, for example.
Yeah, look, it's been very interesting. I need to sort of unpack that in 2 ways, or from 2 points, excuse me. Prior to COVID-19 and during COVID-19, what I mean, so prior to that, there was certainly much more from state to state travel, in particular, Victoria, New South Wales going north to Queensland. However, during the period of COVID-19, which I characterized as saying calendar years 2020 and 21, what is actually happening is, I'm generalizing now, please, Mark, but what is happening is people are staying in their own state. They're actually exploring their own countryside. They're re-establishing habits that happened in the 70s, 80s, and 90s. And so there's a greater amount of our bookings in New South Wales, circa 90% that are in New South Wales for New South Wales. And the same thing is happening in Victoria. Queensland, because of the border closures, it's thrown a real wobbly, and I'm going to use that word wobbly because with respect to the government of the day there, people are unsure when borders will open and close. So people are tending to stay in their own state. But what is really pleasing is that, like I mentioned, the re-establishment of habits. People are exploring their own backyard and they're liking it. And what is really interesting in our business today, what we're seeing is that, for example, not to pick on Sydney, but let's pick on Sydney for a second. What we're seeing is Sydney siders going up, the same travelers are popping up in Port Stephens or in Jervis Bay or in Mollymook, in Bathurst. And we're seeing that in our platform right now. And we're talking to those travelers and we're re-establishing, we're helping them choose new destinations, as you mentioned, Coffs Harbour. And so that's really, really pleasing to see. And I think over the coming years, and I don't want to say that I'm forecasting anything here, please, is that my sense is that re-establishment of habit will continue and will stick.
Okay, we're just pushing up on time, Will. I'm going to squeeze one more in from the audience. So apologies to people in the audience if I didn't get to your one. What is the cost in addition to the online travel agent? And when you acquire, well, this is actually two, but let's go with the second part of this so it gets more interesting. And when you acquire the real estate management rights, does the real estate agent stay involved? How do they earn commissions, if any, post you buying the rights?
So, great question. Number one, I'll try and break this down, Mark, into a few different areas. Number one, I mentioned earlier about brand equity in the local area. It's really important for us that we continue those relationships. And it's not just with our housekeepers and electricians and plumbers and linen providers, etc., but it's actually also with the real estate agent that we're purchasing from. And what we do there, we do two things. One, we have a legal contract. We have a referral back and forth to each other so that the properties that the real estate sales agent may sell, we refer them to us for appraisals so they can holiday manage. We can holiday manage their property. And two, an owner from time to time may want to sell and we hand that lead over to the real estate agent. So we're connected. But not only are we legally connected, but we're emotionally connected. We actually get involved in their lives. Our people are still their people. And we actually make sure that we help each other the weeks, the months, the years after we've acquired. So there's continuity. The second thing that is interesting here is that you mentioned about, and what happens is, I can hand on heart tell you today that quite a number of our future leads are coming from the acquisitions that we have done in the past and are presently doing. They're seeing what we do and the changes we make and don't make, which is more important. For example, we don't change any of the cleaners. We don't change any of the electricians or linen providers or gardeners. We make sure that those local businesses, those local people are still connected to the house that they've always been connected to. It's very important to us. And the other thing that's interesting is when you say, how do they earn commissions? Look, there's different types of commercial arrangements that we have across the country with different referral partners. It's too much to go into now, but we're open to ensuring that both parties win, not immediately, not just for the immediate transaction, but also for the future transactions.
Well, unfortunately, we're going to have to leave it there, but the contact details are there for Will. If I didn't get to your question, please reach out to Will directly, or if you want to take him up for a one-on-one, perhaps to kind of delve into both businesses in a little more detail. And obviously a little more detail will become evident post the IPO now as ALO gets into the cadence of ASX reporting. Will, thank you very much for joining us, our first ever presenter from Newcastle. So good to break some new ground.
Absolutely, Mark. God bless you. The Newcastle is just driving and thank you very much for allowing Newcastle and Alloggio be part of your show this morning. God bless you, my friend.
Okay, thanks, Will. And if you could just please stop sharing your screen, as we are going to quickly run down to Canberra. And I know Daniel is standing by there for us. Yeah, I can see the cover slide of your presentation now, Daniel.
Hello, Mark. How are you?
I'm good. If you could just turn the volume up slightly on your laptop or desktop, whichever you're working after, Dan, it's just a little bit low.
Can you hear me now clearly, or?
Yeah, no, that's better. And I think our first presenter from Newcastle, I think Daniel, you were our first ever presenter we've had from Canberra.
Well, Canberra's a funny little place, but it's surrounded by national intelligence, law enforcement. We're in the bubble up here as well, but it has an amazing cybersecurity ecosystem which is developed in Canberra. So
I will let you dive right into that with your presentation now.
Great, thank you very much, Mark, and hello to all the listeners out there, and thank you for the opportunity for me to be able to present the company archTIS. My name is Daniel Lai. I'm the Managing Director of archTIS. My background goes into some of those said agencies. I came out of the Australian Customs Service. I was the inaugural Director of IT Security there, which certainly influenced it, and I worked for a number of multinational software companies as well before trying to take on this problem of trusted information sharing and establishing archTIS, founding that with a couple of other people who'd also come out of a number of agencies. archTIS stands for Architected Trusted Information Sharing. And what we do is we solve complex information sharing and collaboration problems and develop platforms and solutions for agencies and industry that have to share sensitive or classified information. And of course, I think we've only seen the start of that market being developed, and its growth is amazing. So we are trusted to safeguard the world's most sensitive information. That's not a boast, that's not an ambition, that is what we currently do. And you'll see through the presentation what I mean by that. So a little bit about us. We're in the data-centric security game. And I'm going to explain a little bit about that as we go through the slides, because it's quite different to Firstwave, who also presented this morning. I just want to make sure we can distinguish the two very clearly. But what we have done is since 2018, when we listed, we developed our platforms, which were already in operation for over 12 years in the Australian Department of Defence. Fourth generation version of that is just being implemented into the Australian Department of Defence as we speak. We commercialised that and came out to solve problems between sharing of information between government to government, agencies and agencies, and industry to government. We've done a couple of acquisitions over the last 12 months, and they have been absolutely transformational for the business and opened up a global network for growth, with major marquee signings across our customer base. And of course, our products are established, and they're also accredited and certified by the Australian government. And in one instance, our platform is also certified by the US government. So moving on. A little bit about the company. We're currently, and this is a little bit old, it hasn't got the update since we did a placement just recently where we raised an additional $6.5 million in the market. So cash on hand is very strong. The market is fluctuating with the microcaps at the moment. They strongly move on price, but that they rebound very strongly too, and very quickly. As I mentioned, we IPO'd in 2018, launched the product in 2019, the Cogency product. We won a landmark defense deal, and I'll talk a little bit about how and why that is very strategic for the company. $4.2 million there. We merged with US company, we actually acquired it. It's very rare for an Australian company to go over and start acquiring US cyber companies, but we did that. And we did it through COVID. It's been, as I said, quite an amazing journey, but certainly has opened up global opportunities for us. And of course, the US market is such a massive marketplace, and adopting technology quite quickly in its competition with the new geopolitical rivalries that have come about in the Pacific. And of course, we have had early and very strong cash results and sales. look, you invest in a number of things. I think investors always look for a number of things. And I think that what people usually do is look at who are the people that are driving the company, what's their reputation, and what's their previous record for success. What's their subject matter expertise? How well do they know the industry? Have they clearly defined a niche for their intellectual property, particularly in the software game? And do they have a strategy which they're executing well, which can drive exponential growth in a global market? So I want to talk a little bit about the people that you're investing in, for those people that are already shareholders or those people that are considering coming on board the register. First of all, Miles Jakeman, who has an Order of Australia. He co-founded Citadel Group. He took that company from nothing up to a $400 million company. It was recently acquired by PEP. Last evaluation of that company was $1 billion. They shifted in and out of defense intelligence and now are in the very lucrative health sector. Leanne Graham, I'm sure that all the listeners have heard about Xero and the success of that unicorn, the New Zealand unicorn for small, medium business financial management and accounting software platform, SaaS platform. Well, Leanne Graham was the person that devised their sales execution strategy for the growth of Xero through their IPO process. Kurt Mufferman, 25 years technology experiences, run a $1 billion NASDAQ company, two-time Deloitte Fast 500, on board driving our sales and our global expansion. Chief Financial Officer previously from Technology One. Chief Engineer is Lee Rowland, 20 years experience. Arina Miraz, who's marketing, and a very deep sales team that's been doing it for years and been very successful as well. So I think that the caliber of our people is fantastic, and the results speak for themselves. Most of these people have only joined the company in the last 6 to 9 months, and what they've been driving in that time period. And some came through the acquisition of Nuclear Cyber, which occurred in December 2020. And it speaks for itself. The revenue was for our first real year in the product game was 4.6 million, up 743%. So it's very significant growth. Cash receipts were up on multi-year deals. For annual recurring revenue was up $2 million. We expect to grow that by 100% this year and continue that 3-digit growth into the next year. Gross profit was up, gross margins were up, and EBITDA was down. So we are certainly got the evidence that we're executing that growth in such an enormous market. And what's driving our market at the moment? Well, our market is being driven because we have all changed the way that we work. A number of you are on the call today doing Zooms, Teams, meetings. All of this has been driven not just by the pandemic and the revolution of work from home. We started doing this well before the pandemic hit, but that has had significant challenges for organizations in the way they manage cybersecurity. And we aren't really a cybersecurity company. We're an information access control company, which is much more important, and I'm going to explain why now. How we access data and the types of applications that we use is very, very different from 2, 3, 5 years ago. You know, we are using Slack, we're using Dropbox, we're using Teams. And a good example of that is prior to the COVID, there was 65 million daily users of Teams. Currently, there's over 120 million daily users of Teams. That doesn't include Zoom, it doesn't include WebEx, it doesn't include. So you can see the expansion rate of those type of technologies and platforms. And that information is no longer all in the enterprise, which means the traditional investment of securing the enterprise is no longer as effective. 62% of breaches are either negligence or from insider activities, sending the wrong email, moving information onto my laptop instead of having kept it secure in the organization. And people are driving this because the way that they work and their productivity is very different now. So what's that led to? That's led to a major movement in what we call the data-centric security market. And that's where we play. Firstwave will provide you managed services. And those managed services include threat management, detection, what's coming in and out of your network, protecting the gateway. Well, that's not what we do. What we do is look after the crown jewels. What we do is secure the information itself and provide policies on that information to contextualize your access. So if I'm in the Qantas Wi-Fi club and I log on to their Wi-Fi system, I might see very basic information because it's an unclassified network and it's an untrusted network. If I log on to the VPN on my phone, all of a sudden I'll see a different level and different context of information because it's more secure. If I walk into the building, it changes again. If I get onto my flight and I land in Hong Kong, it might cease all activity on my phone and information in and out of that device. And the user not doing this, the rules that are applied to that data, which travel with the data wherever it goes, are doing that. And that's really what we do. So information is now risk managed, contextualized, and always traveling with the data. Now, we will still need network controls, and we will still need service providers, consulting companies to help advise us, service management companies like Firstwave to continue to do this work. But now what we're doing is making sure that the data itself is protected. And this year alone, there was over $1 trillion in corporate losses through cyber attacks, ransomware attacks, etc. By 2024, it's estimated to be a $6 trillion loss, which would make it equivalent to the third largest GDP in the world, behind the US and China. So the significance of this is huge. Last year, the Australian Prime Minister stated that he was going to invest $1.6 billion in cybersecurity and set up the Cybersecurity Strategy Board. But I'll give you an indication of the type of money that's being spent on that. That's just for government. Australian Department of Defence, which has a $270 billion capability uplift program, has $15 billion allocated to just information and cybersecurity. So that's the type of money that is now being spent. And that's just on the Australian government side. In the corporate side, with the legislation coming out on the National Critical Infrastructure, which basically incorporates all industries and holds directors of ASX-listed companies accountable for securing their digital information and networks. So this is only going to get bigger and bigger. How do you know that we've got something and that it's any good? Well, just have a look at the type of awards we've received. NC Protect, which does that policy enforcement for the entire Microsoft suite, Teams, Yammer, Office 365, Azure, file sharing, all of that type of stuff. It's won in 2020 and in 2021, it won 6 gold medals in the US Cybersecurity Excellence Awards. This year, archTIS has been nominated for the Defence Industry Cybersecurity Business of the Year, and that award is announced next week. So we have the credentials and the respect if you don't know much about cybersecurity. And of course, the last thing I want to say is some of our products are securing top secret information in the Australian Department of Defence, both US and Australian information. You don't get those credentials lightly. So what's the market and how fast is it growing? The data-centric security market is expected to be a $10 billion market by 2023. It's growing at a compound annual growth rate of 23%. Just think about it, 23% compound annual growth rate. And that's the market that we're playing in and we have been established in for many years. archTIS was originally established in 2006 as a consulting business, and we've basically taken all of the intellectual property and started developing products based upon what we've learned over the years, securing defense and intelligence networks. Our go-to-market strategy is a truly global market strategy. We've got those big chunky deals like $4.2 million in defense, but those government deals take a little while to establish. They're usually a 2-year to an 18-month process, but they're extremely sticky and they grow and grow and they stay in there for years and years. We've started attacking the enterprise clients as well and diversifying our market outside of government into defense industrial base, such clients as Northrop Grumman, Thales, Raytheon, Lockheed Martin, and again, because they're global businesses, they have a need there. And one deal that we did with a large German software company that does ERP systems, they're now spreading that our product across their corporation globally as well. So we're seeing not only the entry point to the need to solve these problems, but the growth within existing clients as well. And again, big brand names, global corporations. In the corporate and SME market, we've built up alliance partners that we're doing, a much smaller deal size, but much more rapid to close. And so we're stretching the whole gambit of the market, where we have a 3-tier model to generate revenue and grow and accelerate that growth as quickly as possible. We've invested very heavily over the last 12 months in regional presence. We now have offices in Boston, we have offices in London, in Australia, and an alliance structure and global channel that is worldwide. And one of the big global partners there is the Microsoft corporation itself. So as I mentioned, Nuclear Cyber, which does that type of policy and contextual access control for or the Microsoft Business Suite, it does it in the cloud and it does it on premise. So those people that are wishing to transfer their business into the cloud, and 85% of all organizations in the world today are using some Microsoft product. Our relationship with Microsoft is really at the head office level, and it's global. We are not out there selling through the mum and dad resellers. We are walking in the door with Microsoft to the US Department of Defense, to defense departments in the UK, in the Middle East, and not only those, but large corporations as well. So what we're doing there is, and how that relationship really works, is that we are a co-sell partner. What does that mean? It means that the Microsoft sales teams themselves, when they sell our products, they get quota relief. And they're incentivized on increasing the Microsoft Azure consumption through Teams and Office 365 and on-prem. And what we do is overlay our additional security so that they can enter exclusive markets, such as the government markets, such as the defense industrial base markets, such as the finance markets, where they need additional levels of security to secure that information and wherever that data travels. I think we've had something like 30 opportunities in the last 8 weeks dropped in by Microsoft into our pipeline, a $3 million pipeline. Average sales, they're about 250,000 of ARR. But it's certainly something that's taken us some time to build up, and it's been worth the investment. The result of that is now we have a global client base across the world in different market sectors. You can see there Corning up the top. Well, Corning does all the smart glass on your all devices. So they own the intellectual property for that. So that's the type of stuff that we're doing. KR Care down there in the middle, that's King Abdullah Center for Atomic Research and Energy. We are securing the nuclear power plant plans for all of Saudi Arabia through that. Northrop Grumman, Department of Defense, Australian Information Officer Commission, Australian Attorney General's Department. We were the system that was used for the Aged Care Royal Commission for those lawyers and the commissioner to build the report and secure that information through multiple different locations. And we have an extensive alliance there. And you can see Northrop Grumman, Thales is taking us globally into defense industries, NTT Data is taking us into Southeast Asia and into Europe, Leidos, etc., KPMG. Back to our acquisitions. We've been very considered about our acquisitions. They have to be accretive. The technology has to be complementary. And most importantly, because we place so much emphasis on the team in this growth stage, the culture has to be extremely well aligned. Nuclear Cyber, we did on the 24th of December 2020. It was an $8 million deal for script, 100% script. So they came in knowing that they only were that they were committed and wanted shareholders to know that they were committed to grow shareholder wealth through that process. Cypherpoint's a little bit of a different one. They're an Australian company. They do encryption for Microsoft products. And who would have thought that the Europeans were suspicious of the US Microsoft company's encryption? That might be a backdoor in that. And we're a bit dubious about using Microsoft's encryption. But, these things happen. And so that acquisition was very targeted, not only because they had an excellent customer base, DHL, Bank of Finland, DARPA, but because their encryption product could be integrated to NC Protect and give our customers an alternate encryption product, which opened up the European market to us. And that is an alternate product to the standard Microsoft encryption. So again, we target that. We've got a very strict M&A procedure and strategy, and it's all about companies that look at that remote work, dynamic access, supply chain management, and particularly all of this is being driven by compliance. A quick use case study on this. you know, we knew we needed to own, and we wanted to very aggressively take a share of that $15 billion that the Australian government is spending over the next 10 years. They are forced now with that. You can all are aware of the drivers, the announcements of AUKUS and the nuclear submarines, the rise of China, the implementation of the Quad in response to that. And we are now having to share information between new allies that we never thought we would have to share information before. That $4.2 million with the Australian Department of Defence was to test the cogency platform about and how well that's shared with those allies. You know, that's informing programs of work which have $1 billion expenditure. Five Eyes, we all know about the Five Eyes over years and years, Australia, Canada, US, and New Zealand, and how they share information. Again, an allied integration of information and sharing and collaborating on that information. But the exciting thing for us was not only were we having success with cogency, we were having, which is a fully integrated SaaS platform, we were having success with the acquisition of NC Protect to secure their Microsoft investments and add value to those Microsoft investments. And last year we closed, you know, $1.4 million in multi-year deals to secure the Australian defence environment, which is the deployed networks for which the Australian forces use. And all of this is being driven in the US and around the world at a time where we have the largest and strongest investment in the defence industries by DIS, which is the Defence Industry Security Provider Compliance Framework for the Australian government. So if you're in industry and you want to grab some of that $270 billion and be part of that, you have to become DIS compliant. Our platform assists them get DIS compliant because it takes care and secures all, the cogency platform secures all of the government information and gives them that, giving them that DIS accreditation for the digital environments. CMMC is cyber maturity model compliance, which is the same process in the US. ITARS is international trades and arms regulations. So we're integrating or building a submarine with a US targeting system on it. That comes under that regulation. And if you breach that, it is tens of millions of dollars if you in fines. If you breach it again, they just stop. They switch it off. You can't have it. And it's what protects the US competitive military advantage. US zero trust mandates. That's enforcing a data-centric view of how we secure data and validate every action of access to the information. Joe Biden, when he came into office in May, ordered all government agencies implement that process. And of course, our products are zero trust enabling. So where to from here? Well, we are now targeting through the Microsoft channel and growth and that investment in that distributed network into the financial services. We're investing in government and defence. We want to own that space, and then we want to export those use cases globally. Healthcare, we've had some significant trials going on in the healthcare sector. Manufacturing, certainly that supply chain security. We hear about it every day. Hacks in a certain area of the supply chain because they're targeting somebody else. And a good example of that is, you know, just 12 months ago, we had the ANU hacked, we had Toll hacked 3 times, we had Austell hacked, we had Parliament House hacked. All political parties have been hacked. And so this is not going away. There was a 300% increase in cybersecurity attacks between 2020 and 2021, and they expect that to continue to go on that rate of growth. So a little bit about us. We've got a significant pipeline. We've got an excellent team. We are going to continue to do organic and growth through acquisition, targeted acquisitions, not just a land grab, but we are highly focused on market capture. And the rest of this year through Q3 and Q4 is about converting the sales pipeline that we've built. We've invested in December last year, we had 1 full-time salesperson. We now have 11 across the world. We've given them 6 months to build up that pipeline across Q1 and Q2 this year, and now we're expecting to close those deals starting Q3 and moving into Q4. So we also raised that $6.5 million to add to the current $8 million we had in the bank to make sure that we can continue to do selective acquisitions and bring together and reduce the cost at the back end of our products sets, and also to continue to innovate that product as needed in the market. We do not have competitors in this space for what we are doing currently. We, you know, out of all the deals we did last year, we were sole sourced in every single one. by government agencies and commercial business. That competition will come, so we need to continue to innovate our product base. And right now, it's just about executing against that significant pipeline, bringing those sales in, and re-rating our stock price based upon sustainable annual recurring revenues and growing those annual recurring revenues. And as I said, we're targeting 100% growth this year. So when I look at this company, it has been transformed over the last 12 months. It is a very different company. It has been professionalized. We've increased governance. We've got the teams on board. They're executing. They've got an extremely large opportunity in a market which has enormous tailwinds, and we are in a very, very unique niche of that marketplace, and it's been driven by compliance and legislation as well. So I think the future is looking really, really bright for us at the moment. Thanks very much, Mark.
Daniel, thank you so much. I'll maybe kick off the questions here. While we wait for one or two from the audience. In terms of future acquisitions, are you looking for something that can give you a new product that would take a long time to develop internally, that you can then go into more meetings and push it as a new offering? Or is it more acquisitions to get you into a new region in the world, up in Asia or South America, or potentially to get you a really good foothold in the verticals that you talked about there in terms of pharma, wider healthcare, financial services? I'm just trying to see where future acquisitions are potentially going to come to fruition in.
Look, I think that you're going to see it's any and all of those independent. Cypherpoint was not only technically aligned with us because we could use that encryption product to enhance the entry of NC Protect into the European market and give a point of difference to Microsoft. That was done also because it gave us that European entry, gave us geographic entry. It brought skill sets which were already familiar with the sales pitch and the business need. And it had the network there to uplift those sales. It gave us a customer base that we could then upsell NC Protect to as they migrated to the cloud. All of the organizations that we are currently engaged with are moving to the cloud and need that additional security. So there was a growth pathway there, and it ticked all of those three boxes. Other areas that we're looking for is obviously compliance software, where we can then infuse the policies to align directly to those compliance frameworks and give organizations the governance framework and automated security to demonstrate against those compliance requirements that they actually have implemented it and they are securing it to stop people from going to jail as a director for failing to address the issue. And all being fine, such as GDPR, privacy of information, etc. But most importantly, to protect their competitive advantage in that space. So it's as long as it and some of these things will be for cross-sell opportunities. So as I said, that example in the Australian Department of Defence and with other companies that are defence industrial primes, we have sold both products into now. They started with one. They liked it, they came back and bought the other product as well. And we are seeing that happening throughout the entire pipeline. So, we're looking for cross-sell opportunities, new market entries, but most importantly, we're looking for the technologies that are going to give us a greater level of service and expand our footprint in those existing and access to new clients in the space of data-centric security.
One from the audience, quickly, Daniel. What do corporates currently use for cybersecurity? Who are you going to be displacing in this market? And what's the sales lead time in the corporate market?
The corporate market, depending upon where in the corporate market, some of these organizations, such as Northrop Grumman, they take a little bit longer because they are, they're headquartered in the US. They have to go through a global certification process for the product to be implemented. We are actually not displacing anything that Microsoft does. We are complementary to Microsoft. When we met up with Microsoft, we had 6 technical meetings to prove to them we didn't break a single thing in their product, and that we were complementary, and we were adding a level of security, and that level of security is really about granular policy control. So I can collaborate on a document through Teams, but when we do it with us, we constrain it to who can you invite into that document, which paragraphs can they edit, how long do they have access to that document. If you want someone to read it, we put a secure viewer over it. It might have your name on it. So if you take a photo of that document and try and send it to somebody else, it's got a mark on there which identifies you as the culprit. So we are enhancing the level of security that Microsoft already offers, so that it can compete in those higher certification required and classified information environments. And let me explain that. FBI, state and law enforcement, pharmaceuticals for intellectual property that might be attacked, financing. So it's about protecting your premium information level, where the majority of that stuff can be taken care of by Microsoft, but what they can't do is get to that extremely lucrative high expenditure space for sensitive information.
Daniel, I think we'll leave it there. We have gone 5 minutes over, and I want to respect your time and everybody else's time. So we will finish there. It was great to hear the story firsthand, and we'll keep an eye on updates as we move through 2022.
Great, thank you very much. Thanks for the opportunity, and I wish everyone a happy holiday season.
Exactly, my sentiments as well. This is our last event for 2021, but don't fear, we'll be back on deck in early January, and it's already looking like we're going to have a fully stacked January of events coming through. So wish everybody a good holiday season, and yeah, chat to everybody in the new year.